Hello, everyone. I have Max Ball and Cameron Dunlap with me here. Max is from Lofty AI, and we're going to get into a lot of real estate related questions here, Q&A, as it relates to the tokenization of real estate through Wyoming DAOs. Max, why don't we start off with what type of property makes sense? What is your target type property?
Sure. Thanks for having me, guys. Currently, we have 160 different properties on the marketplace, ranging from single family homes, duplexes, triplexes, some commercial properties, multifamily office. We have a few parcels of land, and then we have a number of vacation rentals as well. I would say probably close to 25 Airbnbs on the marketplace. So it's a wide variety. Most of the properties are rental properties where the owner is essentially looking to sell a portion of their equity to investors on the marketplace. We have as well a few properties where the actual seller lives in the property and they're selling equity in their primary residence and essentially paying the investors a rental yield and then purchasing the equity back at a future date. And so a number of different properties, different structures. Really, with our tokenization infrastructure, we can launch any types of properties with any different structure as long as it's legal, of course. So it's very flexible.
Yeah, and a friend of mine who has, I think, like 16 and 32 unit buildings there in Texas, he's done some deals with you guys recently on this. Uh, and basically, did they get a share of the rent and also a share of the, let's say they did, what is it called? Cost segregation analysis, where they did the accelerated depreciation on the property. Does that buyer or those tokens get that same benefit that the owner of the property does?
They would. You're essentially getting the same benefits as you would in a traditional investment, because that's really what this is. Before a property's launched on our marketplace, we move the deed into a new Wyoming LLC that we've already formed and paid for. So every single property you see on our marketplace is owned by an individual, unique Wyoming LLC with the exact same structure. We then create a property page for that property, actionalize the LLC into $50 tokens, at which point the seller can click the sell button and sell tokens to investors, which represent direct ownership in the LLC that owns the property. And so forget about all the bells and whistles, tokenization, all that. Really, all we're doing is making it easier for people to bring on partners into their LLC. And so from an income and a tax perspective, this is treated the same way as if you just started an LLC with three friends and bought a property under that LLC. We just make it easier for more people to own an LLC with a property together and give them a liquidity option whenever they need it. And so that's really all this is at the end of the day.
Yeah, which is a real nice way for people to get into a rental property that couldn't afford it otherwise, right? You're able
Right.
to get in there with a small, is there a minimum dollar amount? Is it $50? Is that
$50.
and it goes from there. And then once they get, let's say they own 5 or 10% of that property, they then get voting rights on what goes on with the tenant potentially as well, that percentage.
Correct. Yeah, you have voting rights even if you just purchase one token of the property. So every decision for the property is voted on through our governance system. And so we, Lofty, we don't own any portion of any of the properties. We don't make any of the decisions. All of those decisions are made by the owners, essentially active investors in the property. So this is much different than a REIT in that sense. This is more geared towards an investor that wants to be involved with the process. They want to know what's going on. They don't want to just sit back and collect rent without really knowing what's going on with the property and not having that intimate experience. And so we've just found through our research that there's a lot more people that are actually wanting to own property and know what's going on with the property when it comes to leases, repairs, than to just put money in a REIT and just have someone buy the properties on your behalf and you just collect a check. We found people actually do like that intimate experience a lot more.
Yeah, that definitely makes sense there. Now, as far as the collection of the rents and the disbursement, how is that done? Do you guys have any involvement in that?
Each DAO has its own separate bank account. And so if you were to list your property on the marketplace, each month you would send the net rent to the DAO's bank account, at which point we will disperse that rent to all of the owners, including the seller, on a daily basis based on their ownership stake. And so that's one of the more unique aspects of our product which really utilizes the blockchain. If you buy a token of a property, you get your first rent payment later that day and every day moving forward. And so you don't have to wait 30 days to actually start collecting rent. And I would say this is, again, one of the more unique aspects of the product, but it's in place for a reason because it helps to prevent unfair arbitrage. Because if we paid out rent monthly, an experienced investor would wait for the rent to come in, then they would sell their token, someone would buy it, and then they'd have to wait another 30 days to start collecting rent. And when I mention arbitrage, it might sound a little weird in the context of real estate, but there are tons of unique arbitrage opportunities. There's people day trading on the exchange because that's really what it is. This is an exchange for real estate. And so you might see an Airbnb with tokens selling at $50. You know that next month is when the peak season starts, at which point revenue will likely go up. You could buy that token for $50, knowing you'll likely be able to flip that token maybe for $60 in a few months once that revenue shoots up. And so there are some unique ARB opportunities. It sounds kind of crazy, and we didn't expect this going in, but there's people that have written trading bots, and it really is just a very interesting ecosystem that you just won't see anywhere else.
You guys are the only one in the game right now. Joe is on here with Cameron. Cameron, do you have any questions for him?
Sure. Yeah. Thanks for being on here, Max. I appreciate it. And I have been aware of you guys for a couple of years and kind of been watching what you're doing. And so when Paul and I were talking about this when we were together recently, I jumped at the opportunity to be on here for this conversation. And I have a rental property that the tenant moved out. We've just done a renovation on it and it's ready to go either for a sale or to continue to rent it. This is something that I would strongly consider because to sell it is going to create real tax issues for me in terms of cap gains. I've owned it for 15 years. It's in South Florida, the property, and recaptured depreciation. So, the idea of maybe doing this fractional sale, I'm curious what the tax ramifications are for, say, someone like myself who has a rental property.
Right. It's essentially treated the same as if you were to sell the property outright. And so when you sell equity, it's treated as long-term capital gains. You're obviously taxed on the income that you receive as well. It's just proportional to your actual ownership in the property. You are able to use the proceeds from selling equity to 1031 exchange into a like property, either on Lofty or outside of our marketplace. We send you a 1099 at the end of the year, depreciation fully factored in. So we handle all the taxes for you. We don't charge anything extra for that. And so really, we spent a lot of time on this. The tax implications are essentially the same as if you were selling the property outright or dealing with a traditional real estate transaction, because again, that's really what this is. It's just a property owned by an LLC. We just make it easier for owners to essentially go in and out of that investment through our exchange.
And you said proportionally. So if I decided to sell 50% or 80%, then I would have the tax implications on that portion of the sale.
Exactly. Yeah. It's like if you and four friends each own 25% of an LLC that owns a property, you would just essentially be taxed on your portion of ownership. So it really works the same.
Got it. Is there any method to utilize your services to effectively refinance the property or not so much?
You could consider our platform as an alternative to refi. A lot of people that list their properties on our marketplace have existing loans with good interest rates. They might say have a 3-4% interest rate. They don't want to refi because they don't want to start paying 7-8%. And so they can list their property on our marketplace, keep the existing loan in place, continue to make those payments, and then just sell a portion of their equity on our marketplace. And because the only fee you pay is just 3% whenever you sell any equity, especially right now, it's a much better deal than you're going to get doing a refi or a HELOC or selling outright, and really not the best market. And so especially right now, our model is extremely beneficial for people looking to get equity out of their properties.
But in the form of a sale versus financing.
Correct. You could essentially use this as a refi if you had an all cash property. If you owned a property.
I own this one free and cool.
Oh, totally. Then, yeah, you could list the property. If it was worth $500,000, you would have $500,000 worth of tokens. Click the sell button. You choose how many tokens to sell at what price you want to sell at, And then when anyone buys tokens, you receive the funds immediately and you could just send them to your bank account. And so, yeah, totally could be used as an alternative for a refi, for a free and clear property. 100%.
Okay, I got you. But if I were to go and put a loan on the property and pull a couple $100,000 out of borrowed money, of course I'd have an interest expense, but that isn't a taxable event. Where with Lofty, because it's a sale, as I understand it, any portion that I sell through the platform would be considered a taxable event.
Correct.
Got it.
There
Okay.
are a few sellers, or I would say maybe like 10 to 12 sellers, who actually put in an initial clause that they will automatically buy back their equity at a future date. So this is set in stone. This would be more similar to a HELOC. We always recommend chatting with your CPA, but technically this could potentially be considered a loan, in which case it may not be subject to capital gains. Again, this is something we always recommend you chat with your CPA with, but if you are buying back that equity at a future date, it could be looked at differently. Again, we're not tax advisors, so this is something we always recommend chatting with your own accountant about. But again, that kind of goes into the uniqueness of the different structures. There is this HELOC model. Even if you don't put that initial clause in place, you can always propose to buy back all of your tokens at any time, regain 100% ownership of the property, at which point you can take it off the marketplace, sell it outright, totally up to you. So really, really flexible in that sense.
Good. That's really, really, really interesting. To utilizing a buyback clause, of course, after a conversation with my accountant, possibly then it being treated as a loan. And I guess the interest you'd pay on the loan would be the difference between what I sell it for today and buy it back for tomorrow. Because I assume if I had a clause where I'd buy back my tokens, they would be at that future value. Am I correct?
Correct. So you can say, and you get to choose these numbers. You could say in 5 years, I will buy back these $50 tokens at $55 per token. So
Got it.
2% annual appreciation for investors. They get a slight premium, and you could actually buy back the tokens at any point before the 5-year period. It would just be at that initially set price of $55 in this example. We don't charge a fee for this. It goes through automatically. There's actually clawback enabled for properties with this guaranteed buyback clause, just so we can make sure to get the tokens back, give them to the original owner. And then, at that point, take the property off the marketplace and do whatever you'd like.
That's really, really interesting. Glad we had a chance to talk about that. Paul, may I? I've got a couple more.
Go ahead.
Okay. Thank you. Do you find that if someone like me lists my property for sale on Lofty versus just say in the local MLS, it brings a premium price, a discounted price, very much market price? What are your thoughts on that?
So we get an appraisal from a third party provider in the area. We get an appraisal of the property, and that essentially determines the price the property is listed at on our marketplace. So that appraised value is fractionalized into the $50 token. But one of the more interesting things is the best properties will typically trade above $50 per token. So we've had properties trading as high as $90 per token. These are typically Airbnbs that are seasonal, and during the peak season, they'll trade at a really high price because the yield coming into investors might be 20, 30. And so the price of the tokens will actually fluctuate based on supply and demand on the marketplace, which we think is really interesting because when you take an Airbnb, for example, if you were to comp out an Airbnb, the price is probably going to come under what the owner expects it to be because the comp approach doesn't take the actual business into account. But if you have an Airbnb that's worth $300,000, that's bringing in $10K a month, which one of the Airbnbs on the marketplace is, investors are likely going to be willing to pay a premium because the revenue is just so much higher really than it should. And so we're seeing that the token prices are really reflective of the sentiment of the thousands of investors on our marketplace. And so it's really interesting to see how those token prices fluctuate really on a daily basis.
And if the tokens are listed at $50 based on and appraised value of $300,000, but the tokens sell at $80, does that $30 premium come to me, the seller, and then later to that token holder, the seller?
Yeah, exactly. You would start with all the tokens in your wallet, and then you can just, so if the property was $100,000, you would start with 2,000 tokens in your wallet at $50 each. But then you would go to your property page, you would click the sell button, and there would be 2 line items saying, how many tokens do you want to sell? What price do you want to sell the tokens at? So we had a property in Hawaii about 3 weeks ago. This was listed by one of the sellers, Earl, who's listed, I think, 5 properties on the marketplace. And he initially listed the tokens, I think, at $65. So he put in a limit order at $65. I think he put one in at $70 and $75. And they sold. This property happened to have a very high yield. And because Earl has built up this trust and reputation with these 4 previous properties that had done well, he is able to command that premium because at this point, investors just want to co-own a property with Earl. Because again, the original seller must maintain at least 10% of the equity in the property. And in most cases, including this case, Earl is also managing the property. And so when the manager is also an owner with at least 10% equity, in most cases over 50%, there's a high likelihood that they're going to manage the property well, because I'm sure you guys know, nobody cares as much as the actual owner of the property, right? I'm sure you've worked with third-party managers. I'm sure there's some good ones. I've yet to come across a lot of them, but really our co-ownership model works great because the incentives are aligned between the buyers and the seller because everyone has skin in the game. So this helps to prevent against adverse selection. And we actually have a Discord group with thousands of people, a separate channel for each individual property where you can go in and you could talk directly to Earl or any of the other dozens of sellers. So before you invest, you could say like, hey, Earl, I saw the insurance policy. I was wondering why you don't have flood insurance for them. And you now have a direct line of communication between the seller. And so there's that really intimate relationship. Right.
Yeah.
Like we Lofty, we're not the ones communicating with the investors. It's purely peer to peer. We just sit in the middle and essentially facilitate the transactions.
So as a seller, I'm not on your platform. There's no way for me to do a full outright sale, wipe my hands of it and walk away.
Correct.
Got it. Okay. That's an important distinction. And I appreciate your sharing that. I also own a hotel, and I have given thought to selling it, paying off the loan, things like that. How does a property like that, do you think, would perform on your platform?
I think it would perform really well. The more unique the property, typically the better it does. We don't have any hotels. I think I can think back to whenever we launched like our first multifamily property or our first parcel of land. They tend to do very well because it's just something new. And with a hotel, this is something that the majority of investors on our marketplace would probably not be able to own had it not been for our marketplace. And so that kind of adds to the allure of the investment opportunity because to them, this is an entirely new thing that they never had access to before. And so this is something that typically people will maybe buy a few tokens in, they'll tweet about it, they'll send it to their friends. And so it really adds that virality component when there's some uniqueness to the property.
That's really interesting. It is a very unique property in a really cool seasonal destination market and it might do really well there. And actually what's going through my mind right now is utilizing this to replace the mortgage.
Mm-hmm.
And then all of a sudden the revenue that goes to paying the mortgage goes to paying the investors.
Yeah.
And I knew I was going to enjoy this conversation.
I think gets you thinking, doesn't it?
Oh my gosh, my wheels are like humming.
Well, one of the things I spoke about with Paul on our initial call is this becomes a really cool way to essentially like rinse and repeat. Because if you list a property on our marketplace, you could pull out some equity, use those funds to buy another property, list that on Lofty, pull out equity. So it really helps you scale up a lot faster.
Sure.
And again, with
the Burr method.
The Burr method, yeah, a better version. With every new property you launch, you're building up that reputation and trust with investors. And I would say out of everything, that makes the biggest difference. Like we have a ratings and review system for each property. There's ratings from investors. You can see that they actually hold tokens of the property in their wallets. And so if you're one of, I would say like the 3 to 4 sellers on our marketplace that have launched at this point, like 5, 6, 7, 8 properties, you command such an advantage because you're just so trustworthy at that point because your other properties have been performing well for the last, at this point, like a few years. And so it really becomes an important factor, that trust factor between the seller and the investors.
Got it. Fascinating. No more questions for now. I don't want to hog too much of the time.
Joe, you got any?
I'm just sitting here thinking which ones I want to ask that are the most important because I mean, I'll come up with 30.
Just start hammering away.
I mean, legality, right? Break down a little bit more the legality of this. Typically, from my understanding is it may not be clear, but more than 3 to 5 people in one LLC kind of becomes something that's supposed to be registered. The SEC. There's also different states that have different guidelines. I think there was also something in California that you guys had a case back 2022 or so. So maybe you could kind of, distinguish between a registration, the DAO at different states, the borders, the thing, and yeah, take it.
For sure. So if you look at our platform compared to really anyone else out there, if you look at, I would say Fundrise, Arrive, Cadre, CrowdStreet, really all of the companies that you could consider competitors to Lofty, they are essentially, and this is nothing against them, it's just the truth. They are essentially funds or REITs that are buying properties and then selling them to investors, and then typically taking a cut of the rent or a management fee and really deciding on when the properties will be sold, right? They could be in some sort of GPLP structure. Our platform is completely different. We own no portion of any of the properties. We make zero decisions on behalf of the investors. All properties are owned by DAOs, which by definition are member managed, meaning there's no managing member. And so even if you list a property on our marketplace and you're managing it, once you start selling any tokens whatsoever, you can no longer make unanimous decisions for the property. So you can't just say like, hey, investors, I think it's a good time to sell. Let's sell. No, you would need a portion of the investors to vote alongside you in order for that decision to go through. And so LLC membership interests are not securities by definition. What matters is the management. And with our platform, all of the investors are active and involved in the decision-making process, from how much to rent a property for, whether to make a repair or not, converting a short-term rental to a long-term rental. And so this active investor piece is a very important distinction between Lofty and any of the other platforms that I mentioned before.
I have a quick question on kind of somewhat related to what you were saying there. I know, I understand that DAO, the decentralized autonomous organization, which allows you to have more people. But actually, I want to get into, let's say you sold 55% interest. It's now you can't decide you want to put an ADU on that property, right? You have to get approval through all the members.
You can't decide if you want to put in an ADU after selling one token.
Okay.
Yeah. Once you start selling any tokens whatsoever, you can no longer make unanimous decisions for the property.
It goes for voting, right?
Yeah, it goes to voting, correct. The process is very smooth. Most of the day-to-day decisions investors voted on in like an original survey they took on our platform to allow the property manager to make day-to-day decisions on like the nightly rate for an Airbnb or whether to make a repair or not. But something like adding an ADU, converting a short-term rental to a long-term rental, selling the property, all of these decisions must actually go to votes. And just going into the ADU aspect, we do have a capital call mechanism where when we launch a property, we mint like 1 billion tokens. And so if there was a capital call for an ADU and that costs $10,000, we can unlock some of the reserve supply, and anyone that paid for that ADU would receive those additional tokens. Everyone else would have their ownership diluted. So this is something that we've done on multiple occasions, whether for repairs or ADUs, solar panels, a number of different instances.
That was my question after you just answered, which was great. Is that based off an after repair or an after repair appraisal or an as improved appraisal? Secondarily, another one got done?
It would just be based on really like the cost of the ADU. So if the ADU costs, $20,000 just for a round number, $20,000 worth of new tokens would be sent either to the owner of the property if they're going to be paying for the whole thing, or they can open up a capital call to where any investors can contribute to that capital call. In this case, $20,000, they would receive new tokens, and then anyone else that did not contribute would see their ownership diluted.
I hate that word.
Yeah.
They contribute to the capital call.
Yeah. Well, I mean, in this case, it's hard. I guess it's kind of hard to say it's a dilution because they're paying for those tokens, fair amount, I assume. Yeah, there's more tokens, but they were paid for. I guess it is.
They were paid for initially. You could even say that the ADU paid for, might cost $10,000, $20,000 would increase the property's value more than that. And so in turn, those initial tokens, even while slightly diluted, would actually be worth more.
And it would potentially add cash flow,
Correct.
which all the token holders would benefit from.
Exactly.
Yeah, more, Joe? I'm sure you got more questions. Fire away.
Just to sum that up, you're taking the position that each member is also, I guess, a manager with a voting right, and doesn't matter how many are in there, and that's your position. Is that correct?
Correct. It's essentially really the same thing, kind of like I mentioned earlier, as a group of friends that come together and form an LLC and then purchase a property under that LLC. We just make it easier for more people to come together and do that without all the annoying paperwork. And then we make it really easy for people to go in and out of their investment, because you could buy a token and you could sell it immediately after. And so there's no lockup period in this case. And so really all we've done is improve the process of owning a piece of an LLC. But again, it's much different because each owner has a say. There is no managing member. It's completely member managed. If you buy one token, you have a say in how the property performs. Just, this is somewhat off subject, but another kind of interesting thing we've started to see is that a lot of the tenants in the properties that are renting the properties on our marketplace will actually buy tokens in the properties that they're renting. And so this is a really unique way for these tenants to actually start to build homeownership without having to sign some predatory lease option rent to own agreement 400 pages long. They just go to the property page of their property. They click the buy button. They could become a part owner of that property and build up that ownership over time. And we've actually seen instances where, just for example, like the tenant of a property owned a few tokens. They actually proposed a governance vote and said, hey, everyone, I actually live in this property. I own 5 tokens. It's really hot during the summer. I would love if there was like a ceiling fan in my bedroom. And at that point, the investors got to vote to provide the tenant with the ceiling fan out of the operating reserve funds. Each property has its own like CapEx operating reserve. And of course it went through. And so this is just something that people have really never seen before. And so it's totally new, but we've been doing it for a while now to where it's really automated. And I can think of 20 different examples like the one I just named. So it is this really just, again, like kind of intimate experience between, you know, the sellers, the buyers, and the actual tenants of the property.
And on that, the ownership, as long as you maintain 51% ownership or greater, you have the majority of voting rights. So ultimately what you decide would end up going through, correct?
Incorrect. We have, again, once you start selling any tokens whatsoever, you cannot make decisions yourself. We
put it out in front of them, right? But you win the vote if you own enough, correct?
Majority.
Incorrect. So once you start selling any tokens, essentially your voting power scales down. And so we have our own essentially like governance algorithm to where whenever you sell any equity, your actual voting power would scale down too. So just to give an example, if you sold say 30% of your equity and now you own 70%, you would need about half of the tokens you sold to vote alongside you in order for that vote to go through. And so we spent a lot of time on this because again, this isn't a syndicate. This isn't a fund where one person is making the decisions. They might have 99% of the ownership, but if they've sold 1%, they can no longer determine, when the property sold, converting a long-term rental to a midterm rental. They would need a portion of the owners to vote alongside them. One, this is for regulations. And two, it really helps to prevent against like a bad actor. I might have given this example on our call, but someone could sell 10% of their equity and then they need to sell the property half off to pay off a gambling debt or something. That should not be possible. And it's not with how the governance system is set up, because the investors would obviously never vote for that.
Great info. That's really, really good to know.
But in that case, Max, the seller who still owns the majority of the tokens could buy them back and do that. Could he or she not?
Correct. If they bought back all the tokens, they can do whatever they'd like. They own 100% of it. They can take the property off the marketplace. They can keep the DAO. They can sell it. It's completely up to them. In the last 2 months, we've had 2 sellers propose to buy back their tokens, I think at $51 and $52 per token. Investors voted yes. They bought back the tokens. Again, we don't charge a fee for that. And now they're selling the properties on the MLS. They were just like underperforming Airbnbs. And so sellers have that flexibility really anytime.
And the only way to avoid that vote you just described where everybody agreed to $52 would be to have a buyback agreement built into it to begin with, right?
Correct. Correct.
Yes.
Yeah.
And what is there a minimum threshold above which something has to go to a vote? So, for example, on my rental property in Port St. Lucie, if I sold half or whatever, and now all of a sudden it's hard for me to make a decision. Well, my property manager said the refrigerator's broken and it's going to be $150 to repair it. Does that go to a vote?
It does not. So
What's that threshold?
Right. So typically it's property managers will have like an NTV, like sometimes it's 500, sometimes it's 350. So those are automatically approved. And the reason for that is when you actually sign up for Lofty, you take an initial survey that asks you questions for more kind of like general things. So like, for example, if there's a repair for under $1,000, how do you want to handle it? The majority of investors chose the option to defer to the property manager's recommendation. Or another example would be like if a lease comes to an end, how do you want to determine whether to offer renewal and how much should that renewal be? Again, investors voted to follow the property manager's recommendation in that case. And so this avoids there being, 10 votes sent out for a property like per month. It's really for like the larger events. But again, like if there are multiple repair estimates that come in, that will typically go to a vote. Really, it's all up to the investors. And one of the best parts about the co-ownership model is when a vote comes up, the original seller who might have been managing and owning this property for 3-4 years, they can offer their recommendations. They could say, hey guys, these are the estimates that came in. I remember buying this HVAC 10 years ago. I've noticed that this model over the years, this new model would have been better. So I recommend choosing this model. And then obviously investors can take that information, they can make their own decision, but that seller can provide a recommendation. And that's a big reason investors love this product because they get to co-own a property alongside someone like you guys that has owned this property for a while and has really that operational experience and knowledge.
And forgive me, what if I'm the property manager and there is no third party?
Right. Which is the case quite often. It would be the same when it comes to like minor repairs and leases and things like that.
Okay. So we'd set some threshold and below which it's up to me, the property manager, I'll just get it done, and above which it goes to a vote. Okay.
Is there a period of time that the vote has to take place by? Like, can you institute 24 hours an emergency situation like that for an HVAC repair that's $1,000 hours?
For emergencies, the vote will come back a lot quicker. Usually we like to give people at least like 4 days, sometimes a week, like a lot of the time a week. If, for example, a property is listed for sale and like an offer comes in, maybe the buyer says, I need to hear back in 2 days. We can obviously send out that vote and say, you have to get that this vote closes in 2 days. And so it really just depends on the situation.
How does an investor look at this? What are the situations in which an investor deems this a much better deal than going to the market and refi cash out?
For someone looking to like get equity out of their properties or like an investor looking to buy tokens?
Like, there's all different situations, but like, why is someone come here? I kind of hear some stuff, but like, why is it Cam just refi his property, cash out? He has no one to respond to, no waiting times, no doubt, approval for maintenance, no shenanigans. I'm basically saying is like, what is the perfect type of client you're looking for that's coming to your platform that makes sense, and what type of deal and why are they even doing it?
So Cam might have 2-3% interest rate on his property. He could do a refi. He could refi at 7-8% at the appraised value and spend a month and a half, 2 months dealing with banks, which I'm sure, everyone in real estate, you're basically like professional borrowers at this point. And I'm sure you've all been through the process. It's not that fun. With us, we can get your property listed in a week and a half. Sellers can actually list their property up to 5% above the appraised value. So that's the limit. And so you're getting that additional bump. And then at that point, you can just pull equity out of your property for only a 3% fee while still keeping the original interest rate on the property. And then one of the more unique aspects is as you pay down your mortgage, so let's say you're paying down $1,000 of your principal each month, you will actually unlock new tokens as your principal's paid down. So if you're paying down $1,000 a month, we send you 20 new tokens at $50 each. Your equity grows as your loan is paid down. And if you're managing the property, you can actually charge the investors a management fee for your services as well. And one other thing I mentioned earlier, like if you have one of the premier properties on the marketplace, not only are you going to be selling tokens quickly, but oftentimes, as you can see right now, there are tokens selling for over $70, which might sound crazy because that's a 40% increase over that appraised value of $50 per token. But for these more premier properties with very experienced co-owners and, lots of revenue, and maybe it's the midst of the peak season, those types of properties can command that premium. And so there's really, I would say, the biggest benefits, it's much faster, smoother. You get to keep your existing loan. You don't have to deal with banks. I would say those are the things we hear the most from sellers themselves. And there's a reason when people list one property, I can't remember an instance where if they owned another rental property, they didn't come back and list that second property after just seeing how easy and smooth the process was with that first property.
What is the marketplace? Are all properties getting filled? What's the time to get filled? What's a typical size? What's the value size of that assets?
Really depends on the property. We've had people sell like 6 figures worth of equity within an hour, even less. We
Let's talk
had
about the bad case. I don't like the good ones, man. Everyone knows there's always the good cases. Tell me
right.
they didn't
So
sell and don't tell
It's
worth
very-
making their max.
It's okay. So, totally understand. It's very rare, and you won't believe me, but there actually hasn't been a situation where someone just really was not able to sell much equity at all. We have such a good idea at this point after launching 160 properties, doing like over 70 million in transaction volume. We have a really good idea of how quickly you'll be able to sell equity based on one, the property itself, you as the operator, and the rental yield. And so if you come to us and say, look, I have this single family home, it's bringing in $1,500 a month. I want to sell $100K worth of equity in the first month. We will be honest and say that that's just likely not going to happen, because we don't want to get into a situation where someone has not sold as much equity as they want to sell. They're not happy. They want to pull the property. It just ends up being more work for everyone, and it's really not a great look. And so for us, it makes sense for us to be as transparent as possible with people before they actually list their property on the marketplace. Of course, for us, we make all of our money when equity is sold. So if someone sells more equity, we get 3% from the seller and 3% from the buyer. So naturally, we want people to sell as much equity as possible. So it wouldn't really be worth our time or whatsoever if someone lists a property and sells like $10K in the first few months.
So you guys are taking 3% from both sides, and are you guys also taking a cut from the as a credit card processing and so forth?
We don't take a cut from credit card processing. That's fully from Stripe. So the only money we make is 3% from the seller, 3% from the buyer on every transaction. Yeah, and that's for limit orders. And this can go a bit into the weeds on kind of the crypto side of things. But each property actually has its own liquidity pool, which essentially allows for people to place market orders, meaning they can buy or sell without actually having to match with a traditional counterparty. And so if you were to go to our website and click staking at the top, you can see that you could stake both USDC or property tokens and provide liquidity in exchange for yield. And so for an investor, even for a seller, if you own a token of a property, you can actually stake or lend that token to get additional yield on top of the rent that you're already receiving. You might be receiving slightly less rent in some cases by lending, but you're getting that APY on top. And so for a seller that sold, say, $100K worth of equity, and that was their goal, and now there's a liquidity pool for their property, they can then stake some of those leftover tokens and get additional yield, which of course you're not going to find really anywhere else, especially with a refi. So again, this, to be clear, that this is not a crypto platform. I wouldn't say we're a Web3 company. We're really using the blockchain for its utility. Our goal is for people to use Lofty and just think it's a great user experience, not realizing a lot of that is because we are built on the blockchain, specifically Algorand, which just has really, really great tech and it's super quick, low transaction fees. But if you really want to get under the hood, there are some kind of unique DeFi elements that allow people to both stake USDC and property tokens.
So,
yeah.
Now, regarding as Cam said it, the buybacks, does that hurt marketability on the initial sale? Like, is that a little bit of a turnoff? Does that reduce your buyer pool? I would think. I mean,
yeah, it's an interesting question. It can be. We had one property, I think it was in Austin, where the owner was buying back, I think, the tokens in 5 years at like 2% annual appreciation. And if you look at Austin's market, the projected appreciation is like -2% per year. So for a property like that, people know that they're locked in at that higher price of $55 per token. And so to them, this removes a lot of the risk. But if you look at another property in an area where the projected appreciation is higher, and maybe the seller is buying back their tokens at a rate of 1% per year, that could throw people off, because not only does it really cap the appreciation, but it really caps the token price. Because if the seller can buy back their tokens at $55 anytime, there's less likelihood for those tokens to trade above $55. So that it really provides that ceiling. But again, some investors look at it at less risk when that buyback clause is included.
So tell us about like the dangers or what to look at from an unwind situation, whether you want to get out of a deal or people won't all vote to sell it, or, you just want to get out of something. What happens?
If you're the seller and you want to get out, you can propose that vote to buy back tokens at any time. So I think this has happened now maybe 7 times. It's gone through all 7 times. There's been 2 instances where the seller proposed a vote to buy back tokens at a certain price. So I think it was $51 per token, and they didn't get enough votes. And so the next day they proposed another vote to buy them back at $52 per token. And keep in mind, we're not just sending out a vote that says, sell your tokens back at $52, yes or no. The seller can put together a proposal for the investors and say like, hey guys, things have changed in my life. Like I'm moving across the country with my family for a new job. We really need to sell this entire property. So I'd be willing to buy back your tokens at a premium, and we can all get out of this deal with a good return. They have direct access to those investors in Discord where they can chat directly with them. And so again, that kind of intimate experience plays well with this concept as well of the seller essentially getting out, because the investors can, I guess you could say, empathize with their situation. And for them, they're getting a premium, maybe 52, 53 a token. Plus they've been making rent the whole time on the property as well.
So, whatever, Paul brings the property to the platform. Paul must be out of that, call it management position at some point. Is the only way via a sale and a vote, or can he pass on that management token somehow to another person?
So there would be a management agreement where Paul would be able to terminate management. The new manager would be chosen by the investors, which has happened multiple times. Less often never with the actual owner of the property who's also managing it, but for like third-party property managers, maybe they're not doing the best job. And then one of the other sellers or co-owners says like, hey guys, this actually just happened for a property in Denver, a quadplex on Alcott Street. Earl, who I mentioned earlier, is taking over management for that property because the previous third-party manager wasn't just really able to handle it. And so Earl's coming in and taking over management. And of course that had to go to a vote as well. And if you go to the property page, you can actually see in the property update section, you can see the exact vote that went out. You can view the results on chain. And this goes back to really the transparency. You can go to any property page and you could view the LLC documents, the inspection reports, appraisals, title reports, lease agreements, loan agreements. You can view the seller's LinkedIn. They all get credit checks. Every one of them has had a background check as well. And so for us, again, as the marketplace, we are not recommending people invest in any of these properties. We are simply giving people as much information and due diligence material as possible to allow them to make the best decision based on their own risk tolerance, essentially.
What do you do from the marketing standpoint to bring in more traffic? What is kind of your marketing?
Luckily, up to this point, we haven't had to pay for marketing. It's pretty much all been organic growth. And that's growing to, again, a little over 70 million in volume. When people use the product and they purchase a token and they get that first rent payment later that day, and they have the ability to sell anytime, they're typically hooked, and they'll want to tell their friends about it, and they'll want to tell their family about it. And so we get a ton of investors through referrals. And then when someone lists a property with us, and now you can just click a button and buy a portion of that property, they'll typically tell their friends, their family, like, hey guys, you can now own a piece of my property for $50. And a lot of the time, the sellers, most of the time, will actually become investors in the properties. And so our supply oftentimes becomes our demand. And then most of the time, or I wouldn't say most of the time for this, but a lot of the time, the investors end up becoming sellers as well, because someone might look at Lofty and say, this is a really unique way for me to diversify. Like instead of having to put down a $20,000 down payment and spend 2 months with inspections and all that. I can put $1,000 into 20 properties in a few minutes and sell anytime. And then they realize I own my own rental property. Why don't I essentially bring that on chain to give myself a liquidity option whenever I need it? Because that's an interesting piece. Some people will bring their properties on our marketplace without any intention of selling any equity. But now they have that ability to click sell. And so maybe in 3 months, they've sold no equity. They have an emergency come up. They need $10,000. They click that sell button. And now they've essentially given themselves a liquidity option whenever they need it. So that's actually a pretty common thing. People listing properties, not even wanting to sell, just bringing their properties on chain, really.
What's the average amount of people are coming in to raise or sell right now per property?
How much per property?
Yeah, like right now, what's the average size being raised or sold?
Most people will look to sell. This isn't going to answer your exact question, but like 30 to 50% of their equity.
What is that, like
I
an
would say
average 150 grand right now, a deal, or what is the average deal size, I guess?
So the last property we actually launched our first mobile home park, I think late last week. The owner, I believe he's looking to sell maybe like a BK in equity, which would actually be closer, I would say, to like 80% of their equity. But again, there's people that might just want to sell 20K in equity. There's people that want to sell 90%. So they can use all that money to buy more properties.
Straight.
What's up?
What's the average size? You're saying 100?
I don't know the exact average size, just because we have like multi-million-dollar properties that are worth 200,000.
What's the average
The
number?
best way to describe it is like the percentage of equity they're selling, I would say, which is usually around like 30 to 50%.
What's the average number of people in a deal?
Tough to say. There's properties with 50 people. There's properties with a couple hundred people.
Let's take a couple hundred. Paul needs to do a $10,000 repair. How does that algorithm work? Meaning, does it weight it? And then once it just hits approval, it doesn't matter if the rest of people come in and vote, or how does that work? Because I know when you deal with people with small checks,
Right.
I don't irresponsible.
It's essentially based on the people that do vote. And so based on Paul's ownership, he can see what his voting power is and the percentage of people that do vote that need to actually vote for that repair to go through.
So if there's like 100 people, he might only need 20 or 30, or like how many people got to respond to get the approval?
It really depends. This is all so for each property, there is a separate operating agreement for each property. And I could post wherever it's helpful. We have an entire walkthrough of the governance system. So you could see if you own this equity, this is how much voting power you have. This is how many people need to vote. This is something I would say this and accounting. And we've spent the most time, which you never expect, like going into a business to spend a lot of building like a governance mechanism or algorithm. But I'd be happy to share that with you guys. It's in the operating agreements too for on all the property pages.
Helpful. I guess just, what are the other things that we're blindsided by on the other side, that where are problems arising from any of the deals that have happened on the platform or are currently operating? What are the problems people?
Right. Well, I would say early on, because we've been doing this for 4 years at this point, our model was different early on. Back then, people would list 100% of their properties on the marketplace. They'd be purchased purely by investors under an LLC, under a new DAO, and then they'd be managed by third-party property managers. And so early on, a lot of our users were coming over from crypto and they wanted more kind of high yield, high risk properties, I would say in markets like Akron and Cleveland and Memphis. And naturally with those types of properties, there tend to be more issues. And when you're dealing with third party property management companies, even the institutional ones, they could just take the turnaround time is just pretty significant, at least from what I've seen, like a week for the QC inspection, 2 weeks to get turn estimates. And so we ran into a situation where like people could kind of see the platform as a way to sell properties maybe they necessarily didn't want for whatever reason. And so really the genesis of the co-ownership model was to align the incentives between buyers and sellers to get rid of any adverse selection. And so early on launching these types of properties, we kind of had to really, again, just learn as we go. We had to create this mechanism to create capital calls and a loan structure. Like we have a universal lending DAO that people can contribute funds to that can provide loans to properties that don't have enough funds for repairs. When you purchase tokens in a property, you contribute an additional 2.5% of your transaction value towards this reserve, which again is used for repairs. So at this point, we really like to, I know this is going a little off the subject. We like to think we kind of seen it all. doing this for so long, especially launching with those initial types of properties. I'm sure we haven't, but again, really our goal, like at this point, is just allowing the investors to be ready for anything. So if anything comes up, we have that infrastructure or technology to allow them to do a capital call, do a loan, whatever the property needs. They can do it, and they can do it quickly.
So are there properties in, say, trouble, crime-ridden neighborhoods that you guys don't want on your platform potentially, or no?
We're a marketplace of if you have a property you want to list, we will list it. And we're not making decisions. We're not doing due diligence personally on the properties. Of course, we require inspection reports and all the necessary material. We will let that person know that based on our data, you will not likely be able to hit your equity goal if you're looking to sell X amount of equity. And we even have a Discord channel where it's like a property preview channel where we post properties that the seller is interested in listing just to get feedback. We've had situations where we posted a property and people could thumbs up or thumbs down it. And the seller was really excited and it got, 50 thumbs downs and 1 thumbs up. And we're just like, look, like we don't control this. Like this is the feedback. This is the sentiment of the collective opinions of these investors. You're welcome to list it. But that right there gives you idea of what to expect in terms of.
I think one of the great aspects of what your company does, what Lofty does, is if I have 70 or 75% LTV on my mortgage on a property, yet I've still got cash locked up, I wasn't able to get all my money out, I can get up to 90%. So I can unlock some more of that cash to potentially use for another deal. I think that's probably, that's something I'm looking at it for. It's probably what a lot of other investors would be looking at it for too. And for people who don't want the whole tax sale, like Cameron's talking about before, where if he sells 100%, he's got all the capital gains, long-term capital gains he's got to pay. But if he sells just a portion of it, he doesn't have as much to pay in taxes. So you can almost save it for years where, all right, I got flexibility. I'm not going to pay as much in tax this year. Maybe this is year to take the sale and sell more of the property. It does give you some tax management ability here, strategic tax.
Exactly. And with the ability to 1031, this is actually kind of new to us. It's something we've been looking into for a while. Technically, you can take the proceeds from selling equity in 1031 into other properties, like properties on Lofty. Or you can 1031 into a property outside Lofty, and then you can launch that on Lofty. And so you can use this as part of your really scaling, like rinse and repeat process that the more experienced sellers will do on our marketplace. And I guess that takes me to another thing. Like whenever, and Paul, I think I even mentioned this to you, like whenever someone wants to list a property, I always recommend chatting with the other sellers that have listed properties in the past. This is a good way to hear really from their perspective how the process went for them. Because again, these are third parties. These people obviously don't work for us. They're people that either came to us through a referral or directly. And so we always recommend like chat with the other sellers. We're happy to give you any of their numbers. They're in our Discord, something that we always recommend, again, because we're just very confident in this approach and how it's worked out both for sellers and for investors.
On the purchase side, the limit order or the marketplace, we'll call it, you could always leave a buy order at a certain price in
Correct. Yeah, exactly. So you might go to the order book and see that there's a limit order for $10 at, or 10 tokens at $50 per token. You could put in a limit order at $49. So it's not going to match, but people can see, all right, I could sell my tokens into $49 per token, slight discount. But yeah, you can place multiple limit orders on each side, totally up to you.
Does people know who the seller is?
They don't know. In the order book, you'll just see like 50 tokens listed at $52. Everything's tracked on the blockchain. So if you were to go to this property specific token, look at the transactions, you could see whose wallet address it is. But of course, you wouldn't be able to know who that person is, except for the seller. It's somewhat obvious what the seller's wallet is because you could see on the blockchain that this initial wallet received all of the tokens. So obviously that's the seller.
So have you found in the last couple of years any periods based on economic conditions or news, let's call it sellers wanting to bail out the tokens and being a little bit illiquid, that people are buying back those tokens at below value?
At times, like maybe when we have like less volume on the marketplace due to like macro.
Also, those tokens, and then somebody in the market's going to shit. People are getting scared. Paul puts in the bids at $20.
Yeah.
$20. Cause he just leaves it out there. If someone wants to dump them, he dumps them, he collects it back and you know, it's a kind of a illiquid market, right? So you're kind of looking for a
Well, it is
someone that
liquid.
needs to get out of their position, right?
It is liquid because you can place you could sell instantly anytime because you could just place a market order. With a market order, you pay an additional 2.5%, which goes towards everyone that's providing that USDC liquidity to the property. And so you're paying a higher fee, but it allows you to get instant liquidity. And this will be my last tangent, but I don't know like how familiar the audience is with crypto, but essentially what we're doing is very similar to how it works like with the stock market. Like with NASDAQ has market making companies that are constantly buying and selling shares at say Tesla and then making a spread. This allows you to buy Tesla without actually having to match with someone on the other side. We've done the same thing, except instead of working with market making companies, we've taken a DeFi approach where people from around the internet come to our website and can do that market making and provide liquidity for both instant buys and sells. And so to your question, maybe the market price for a property, maybe there's a delinquency in a repair. So the market price might be $35 per token. So you could sell instantly at $35. You'll pay that additional fee, but maybe you'll want to place a limit order to sell at $40 because you'll net a little bit higher. Maybe someone comes in and places a limit buy order at $36 and $37. It really does act really just like the stock market, but behind the curtains, we've just taken this DeFi approach compared to like what the NASDAQ does, working with like institutional market makers.
On that liquidity, can you give us an idea of the depth of that? Look, I assume we could call it a liquidity pool since we're really talking about crypto.
Yep.
And can you give me an idea of roughly what it pays the liquidity providers?
I don't want to jump to like, it depends on the property, but it really does. I could pull it up right now. If you go to Lofty and then you go to staking at the top, you might see properties with like 6 figures worth of equity and liquidity, where if you own say 6 figures worth of tokens, technically sell to that liquidity, you will face price slippage by essentially like imbalancing that side of the liquidity pool. Some properties might have less liquidity, which means there's going to be more slippage. And so this would be the best example of it. Really does depend on the property. It depends on how many people are staking, whether people are staking their property tokens. And you could see on our website for every single property, how much is staked, both for USDC and property tokens, and the APYs generated both over the last 7 days on average and 30 days. And so you could see for some instances, if you're staking property tokens, you could be earning like a 10% rental yield and another 5% from staking. So it's really just a unique way to compound your returns over just the income you'd receive from a traditional real estate investment.
So if I want to stake, I choose the property that I'm providing that liquidity for, or I choose the token that I'm going to invest in, basically.
Exactly. If you go to, it's just amm.lofty.ai or just click staking at the top, you'll see all the properties. You can just click select next to any of the properties that you want to stake in. And then you can stake both USDC or property tokens. And before you decide to stake, you can see what those APYs are.
You had said that it did, depending on the property, the stakeholder might make a 5% premium over and above whatever rent if they're staking property tokens. For the sake of the audience, and maybe for us, where does that 5% come from?
It comes from that additional 2.5% fee that people pay when they do market orders.
I got you.
Someone places a buy market order for $10,000 and they're paying an additional $250 fee. That $250 goes directly to anyone that is providing that liquidity through staking. And you get that instantly. So that just comes directly to your wallet right when that order goes through. And then you could just withdraw that right away. And it's interesting to know if automated market makers obviously have been around for a while. Ours is a bit different. It's a proactive market maker, and really it's geared towards reducing volatility because real estate is, let's say, a lot less volatile than some meme coin that really has no real utility. And so we have an interesting mechanism built in to where if you are essentially withdrawing liquidity and it imbalances the pool, there's actually a penalty that you'll pay. And that penalty fee goes towards everyone else that is continuing to provide that liquidity. And so our AMM is less about like yield farming and jumping from one property to another. That penalty is worked in because, again, these are less volatile assets. So the token price should not be changing as much as it does with like a traditional crypto investment. And so this is something we built from scratch. It's very unique. But again, the entire point of it is just to let people buy and sell instantly, like full stop. That's all people really need to know. But if you want to get under the hood, you can really dig into the more, I don't know, kind of like rabbit hole DeFi elements, if you will.
Quick last question I have for you, Max, because I'm going to have to cut this off in the next 5 minutes or so because I got to go play pickle with somebody. Pickleball, that is. Cameron and Joe know how serious I am about it.
Thank you for clarifying that.
Yes, I wanted to make sure the audience knew that. Pickleball. So if you did cost segregation analysis on a property to get that accelerated depreciation over the first 3 years, does that give that token extra value, obviously, from somebody buying that to get that extra discount with taxation? Or does that not pass through?
Inherently, it wouldn't increase the value of the token, but someone might see that property had a cost segregation study done on it, which would allow, I guess, them to be willing to pay a premium for those tokens.
Okay.
Yeah. And this really goes for anything. The tokens start at 50. Most people will list their tokens initially at 50. There could be some element of your property that makes you think that the token should be worth more than 50. And if you think that's the case, list them for more than 50 and you'll very quickly see if the market agrees with you or if it doesn't.
Got it.
You'll know right away. You could always cancel that order. You can relist them for less. Again, it's very flexible in that sense. But again, you'll very quickly know what the market thinks of the price you list your tokens at.
Awesome. That's everything I got. If you guys got more, we could set up another time with Max, I'm sure. And we could always think of stuff, write stuff down, and then maybe have a follow up with Max again here. If you're open to that, Max, then we're
Good.
awesome.
Very interesting, Max. Thank you. I appreciate it. I've got like Paul, I've got a large audience of investors that I can present this to. I think given all that you've shared today, I can do that with a pretty good degree of confidence.
Awesome. That'd be amazing. But like I shared with Paul, like happy to figure out some sort of a affiliate program for you, of course, if you're going to be sharing this with both investors and sellers. So happy to jump, talk about that more async, jump on another call, whatever works for you guys. Cause again, we do appreciate always like new investors, sellers coming to the marketplace. So that means a lot.
Beautiful.
Very good.
Appreciate it, man. Appreciate everybody jumping on here as well.
Thanks for putting it together, Paul.
You got it.
Thanks, Paul.
Joe, see you later.
Take care.
All right. Have a good one.